Welcome to Bluechip Dialogues. I'm Garett Jones, your host. I'm the chief economist at Bluechip. We're a stablecoin rating agency. We give letter grades for stablecoin economic safety from A+ through F. We've given no A+, but plenty of Fs. I'm very happy to say that our guest today is Professor Harald Uhlig, the Bruce Allen and Barbara Ritzenthal Professor of Economics at the University of Chicago. He's written on a variety of topics, including from time series econometrics, the effects of monetary and fiscal policy on the economy. But today, what we're going to talk about mostly is his research into cryptocurrency, fintech, and payments innovation. Thank you so much for being here, Harald.
Well, I'm very honored to be here. Thank you for the invitation.
Well, I wanted to start off with your paper, Some Simple Economics of Bitcoin. And that came out in about 2019. I assume it had been something you've been working on for some time beforehand. Tell me a little bit about what the simple economics of Bitcoin are.
Yeah, so this is co-authored with my colleague Linda Schilling, who is at the Washington University in St. Louis. And I've written a number of papers with her. There's been a very productive co-authorship. So, she actually was visiting the University of Chicago and she said, I want to write a paper on cryptocurrencies, on Bitcoin. I mean, at the time, we didn't really know the universe, I have to confess. And this was in roughly end of 2017. And then we fairly quickly produced a draft and started circulating it. It got invited at the Journal of Monetary Economic conference in Guernsey and then published shortly afterwards. So we were very pleased with the whole process. So what's the core idea? I mean, there are lots and lots of websites that say this will happen to the Bitcoin price. I mean, I just Googled Bitcoin price and it gives the current price at $64,000 something dollar. And then right below it, it says, what will $1 of Bitcoin be worth in 2030? So people want to know, right? Obviously. And, we wanted to understand it. We wanted to, have an economics framework to understand it. And let me give you the answer to the question.
Sure.
If people are risk neutral, then my expectation of, 1 Bitcoin in 2030 is exactly the price that it is today, namely $64,800 something dollar. It's a martingale. So that what emerged from this paper. Now, people are probably risk averse, and we know that investing in Bitcoin is risky, and there have been quite large risk premium on investing in Bitcoin. So it could be anything, in expectation, I should say, between 64,000 and 500,000 probably. But then there's lots of volatility around it. So that's not going to be not going to make your typical investor very happy, but that's about as precise as we can answer that question. So what's the idea? So in the paper, we say we take a monetary perspective. If you look at Bitcoin from a financial perspective, and I think Warren Buffett has said as much, it makes no sense because it never pays any dividends. If you hold Bitcoin from here on till eternity, you never receive a dividend, so why possibly do this? But there are other assets that share that feature. For example, your dollar notes in your pocket. If you take out the dollar note and hold that till infinity, it again pays no dividends, right? So you'd say, what's the point of holding that? Well, there's a point in holding your dollar notes in your wallet. You can make payments with it. And Bitcoin, you can make payments with it. So we said, let's look at it from that perspective, and let's imagine an economy where you can use both dollars and Bitcoin for making payments. We wrote down a generalization of an old paper, fundamental paper by Carrington and Wallace on exchange rate indeterminacy. And we generalized it because we wanted to see whether there was a reason for people to speculate in Bitcoin, to be hodlers, to hold on to Bitcoin for a while. That's something that they couldn't have done in their papers. We needed to change the model, and there's some other changes too. And when you look at that, the first thing you can think about is what's going to be the price in US dollar of a US dollar that you have today, right? So if you put a US dollar and put it in your drawer, how many US dollars will you have 20 years from now? And I think we all agree, unless there's fire or something, it's exactly $1, right? You take it out 20 years from now, and there will be no surprise that it's again $1. So another currency that works as a perfect substitute for the dollar, and that's what it's a simple model.
Yes.
That's what we assume in the paper, will have the same feature, an expectation whatever its dollar value is today will also be the dollar value, in whatever time horizon in the future. That's the essential logic. The same logic by which a dollar is worth $1 20 years from now, if you put in your drawer, also says a Bitcoin that's worth 64,000 today, it's going to be worth 64,000 20 years from now, if you're risk neutral, right? With risk aversion, risk plays a role. There was some interesting other. So let me just say this: when you look at the typical video or website or whatever, they're always worried about these halving events. Mm-hmm. What are halving events? So Bitcoin functions by having so-called miners maintaining the system, and they have to solve numerical problem essentially. And if they do this correctly, they get these rewards. I mean, otherwise they wouldn't do that, right? So they get these rewards, but and they get rewards in Bitcoin. But these rewards halve about every 3 to 4 years, and so people say, "Oh, now it's halving. That means something happens to the price." No, I mean nothing happens to the price, because people completely foresee that this is going to happen. So it's a foreseeable event. Why should anything happen to the price? So that's one example. The other interesting implication that this had was who ultimately pays these miners. And
this is my favorite result in the paper. I have to say.
I see.
Okay, please
Thank you.
continue.
Yeah. So because you would think it's expanding of Bitcoin. So if you just look at Bitcoin as a universe in itself, sure, then the holders of Bitcoin would have to pay for the miners because you're just expanding the quantity of money. But in an economy where you have dollar and Bitcoin coexisting, it's the total amount of money that's in circulation that counts.
Exactly.
It's not just Bitcoin. It's a sum of dollar denominated in dollar and Bitcoin denominated in dollar. That's the total quantity of money. And the central bank governs how much total money there should be because they're very worried about the price level, right? So that's what we also assume in the paper. You have a central bank that wants to keep inflation in check. How do they do that? And that's not the topic in the paper. There are millions of papers written on this. So somehow they managed to do this. And in the paper, this means that as the quantity of Bitcoin rises, the quantity of dollar has to fall. It can't rise quite as much. Mm-hmm. So that means with the appearance of Bitcoin and with the payments to the miners, the central bank can't issue quite as many dollars as they otherwise would have. In other words, it's the central bank of the United States or the central banks of the world, if you broaden this globally, which are paying the miners. The miners are paid for by the central banks and therefore ultimately by taxpayer resources, if you like, because central bank profits go back to the fiscal authorities and they spend it on whatever they want.
So what I loved about the paper is that you took the Carrick and Wallace result, which is a super powerful result that had been around since the 70s, and you took rational expectations, macroeconomics really seriously and applied it to that.
Right.
In just a world of basically two currencies, right?
Right. That's right.
And you got a very powerful result. One is obviously, to us, obviously, Bitcoin is going to follow a random walk.
Right.
From our point of view as macroeconomists sitting here all these years later, the surprise to some extent should be that we got so many positive rises from the martingale, so many pluses.
Yes, right.
The unsurprising thing is that many other cryptocurrencies have had downside shocks,
Absolutely. Right.
So yes. Bitcoin turned out to be the market dominant one. I think that's a puzzle for that future researchers get to address. But the second fact, which was entirely new to me, is this idea that it's U.S. dollar holders who end up paying the Bitcoin miners.
Right.
And it comes from the fact that if we take Bitcoin seriously as a payment mechanism, as a form of money, there can only be so much money in the world because consumers only want to demand so much money. That goes back to, Friedman, Fisher, and the classic money demand
Smith,
stories.
Even quantity theory. That's right.
Yes. So it's a reminder that this is a nice example of how a technological change, Satoshi's white paper actually got us to understand a little bit more about how money works.
Yes. No, that's true. And you're absolutely right. It's the Carrick and Wallace result revisited. I mean, there are some changes in the model and so forth, but we really try to give much credit to Carrick and Wallace, and the stochastic version, which is by manually pegged. So, I mean, we are standing on the shoulders of giants and have expanded their result. And these old results lead us to think about new phenomena, which is also, good thing.
So going beyond the paper itself, like it's been quite a few years since you wrote it, and yet Bitcoin rose in price a lot. It's come down since then.
Right.
But do you personally have a theory of how Bitcoin has done so well over this time?
Yeah.
Why didn't all of the potential substitutes basically crowd it out?
Yeah, so the question is two parts. How come that Bitcoin has risen so much since you wrote the paper? I used to present the paper early on, and people were asking that question, and I said, well, I was appealing to the anthropic principle. I said I wouldn't be writing a paper about Bitcoin if it was trading at, I don't know, a cent for 100 Bitcoin. If you needed, I don't know, what was pizza day? I forgot the exact amount, right? But if it takes still, enormous amount of Bitcoin to buy a pizza, it's not an interesting phenomenon. So the fact that it rose so much and became something that's quantitatively large, got the attention of economists, including myself, and then you write the paper. So it's the rise in price caused the writing of the paper. So you can't look at that as testing the theory in that sense. But it is true that Bitcoin has been rising since then, right? Since 2009, I think in 2009 when we published the paper, I mean, it sort of bobbed up and down somewhere between $8,000 and $17,000 at the time. Now it's at 64,000. It reached, I think, 120,000 at some point. So clearly has been rising overall with lots of ups and downs, of course. And the question is good. Why is that? And I used to think this is really hard to explain. My favorite explanation nowadays is this is just reward for risk. So if you hold Bitcoin, you're holding a very risky asset or a risky currency, really. I shouldn't. So let me also say this just as an aside. This is a distinction between a currency and an asset. On an asset, you get a rate of return. You expect a rate of return because there's payments made. So in a world where we aren't risk averse and you have a government bond, it will increase in value over time. Whereas if you have a dollar, it doesn't increase in value over time. So that's also a key distinction. One shouldn't expect a return on Bitcoin. The benchmark is a martingale. Yet we have seen these returns, and there may be a reward for holding risk. So financial economists, for a long time have benchmarked how to think about risk-return rewards, and the term there is a Sharpe ratio, right? So you're dividing the excess return, which really here should be the excess return over zero. So I'm quoting now numbers that come from websites that compare to the rate on Treasury, which in some ways you shouldn't do here, but that's okay. It's probably just a small difference. So you look at this excess return that Bitcoin had over this time relative to and divided by its volatility, divided by its standard deviation. And that gives you what's called the Sharpe ratio. And, we have a sense how large the Sharpe ratio is for stocks, for other assets. And it turns out, Bitcoin has a fairly high Sharpe ratio measured this way, but it's not outlandishly large. If you look at that, you say, okay, maybe because it's so volatile, and people want to be compensated for holding it, it also rises in value. I think the Sharpe ratio, if I remember right, is maybe 2 times or 3 times as that for stocks, which is a very good deal. But you have to be willing to hold Bitcoin. Yeah. So that, but I wouldn't say that that's a final answer, right?
Yeah.
But it's an intriguing answer at least, to an intriguing starting point to go from there.
Yeah, this idea applying Sharpe ratio to Bitcoin is really interesting. So Sharpe ratio for the S&P 500 is, say, what, 1/3 or so?
Yeah, on an annual basis, right? Yeah,
on an annual basis. And then so then you're saying for Bitcoin, it's more like 2/3 in that ballpark.
Yeah, that's right. So I actually have a plot here. I think that's about right. I have to do the math exactly, right?
Sure, but it's in that ballpark.
Yeah, right. Yeah.
So I'll use this as an excuse to ask a different question then. So the risk aversion versus loss aversion as an explanation for stock returns. Do you personally think that run-of-the-mill constant relative risk aversion utility functions that we economists use can do a pretty good job explaining the return on stocks? Or do you think we should go to something a little bit more behavioral.
Yeah, so I should go back on the Sharpe ratio for Bitcoin. I really don't know the number precisely. I should calculate it. So, I mean, if somebody watches this, I mean, go ahead and
we'll have that on pause.
Right, and calculate it yourself. Yeah. So, does risk aversion do a good job for explaining the equity premium that we see for stocks? Right. So that's the question, and that's a very good question. And Mara Prescott famously formulated this as a puzzle. They're stuck in levels for risk aversion that they thought were plausible, and then you get nowhere near the amount of risk premium that you see for stocks. So that has created a huge literature of how to think about it, and loss aversion is one direction this literature has gone. Catastrophic risk is another direction that this literature has gone. So there's a plethora of explanations. I think my favorite explanation these days is, and I should remember the authors, it's embarrassing. So there are authors, I think they're at Stanford, that have constructed what they call a zero beta portfolio. So what is that? So normally when we calculate the risk premium of stocks versus bonds, we take, say, treasury bills and say, oh, they have a very low return. And we look at stocks, oh, they have a much higher return. But of course, treasury bills serve a very different function, right? They're used by banks for a settlement instrument. They're used as collateral in contracts and so forth. I mean, there's a good chance that neither you and I hold treasury bill as investment. Why would we, right? I mean, we don't do these things that banks do. So if you want to look for, so it would be nice to look for a truly riskless asset, or one that doesn't carry risk premium really, but that doesn't offer these liquidity services that treasury bills do. So that's what these authors are doing. And the way they construct it, they take stocks and they construct the stock portfolio so that it doesn't have a risk premium, so that it's uncorrelated with anything that should induce a risk premium. We know various factors, give us risk premium and so forth. So they're very careful in constructing a stock portfolio that should have a zero risk premium given all these usual candidates, and then they calculate the return on that. Now it's risky, but it's a risk that people shouldn't care about because there shouldn't be risk premium involved. Yeah. And then so that's their zero beta portfolio. It's beta means the regression on these factors. So there's a zero. That beta is zero on these typical risk factors. The zero beta portfolio. And then you can calculate what's the S&P 500 return relative to that. And it turns out that that's small. So the zero beta portfolio, maybe unsurprisingly, because it's also stocks, you could argue, right? So maybe it's, is it an answer to the question or not? It's sort of slightly cheating, if you like, right? Because you're constructing a riskless portfolio, not riskless, but a portfolio with risks that people shouldn't care about out of stocks. And then you're saying, oh, these other stocks that have a risk premium, they now only have a slightly higher risk premium. I think that's a good start for an answer. It's certainly clear that treasury bills serve functions in financial markets that stocks don't. And so thinking about what is the right benchmark to benchmark this premium, I think is a good idea. Anyways, so that makes the premium much smaller, and therefore the needed risk aversion much smaller.
Yeah. I looked this up while you were talking. It's the zero beta rate is the paper, as you said, and it's by Detella, Habert, Kurlot, and Wang.
Exactly.
W-A-N-G.
Yes. Right.
Yeah.
Yes.
So I remember seeing it in passing a while ago. Now I'll have to go back and see it. I think it's one of these reminders. It's a reminder that, in a way, their answer is that when we plot the security market line, their story is basically that we have the y-intercept wrong, and it's really more like this.
Yes, right. Yes, right.
Yeah.
Exactly, right.
The reason I went on that detour is because I just thought, if the Sharpe ratio for Bitcoin looks particularly appealing, it's a sign in a way that these guys are getting a really good return for taking a moderate amount of risk.
Right.
So it looks like, yes. Which does fit the theory that the people who are in that part of the market, who are in the Bitcoin market, are kind of risk tolerant and they're getting a pretty good rate of return on their money.
Well, it says they must be very risk averse, right? Because otherwise they bid up the price much higher, right? They realize there's volatility and they say, oh, it's so volatile, I don't want to bid too much on it. And so then the price is low and the expected return is high. So it must mean that the people in that market are risk averse. and then once one thinks about that explanation, and I mean, it's something that that it's in my mind, right? It itches on my fingers to try to get deeper into this because it raises a whole host of other questions, right?
Yeah.
In the beginning, Bitcoin was just a small share of the market that, and any asset that, and Bitcoin returns, I should also say, the volatility is pretty much uncorrelated with anything out there. So various authors have tried to see whether that loads on risk factors, and the answer is by and large no. So it's an asset that has volatility, all right, but in terms of world portfolio of assets, it's tiny. And so therefore adding some risk that is not there otherwise that you don't care about shouldn't carry risk premium, right? So how come that there's this risk premium when it was tiny? Now it has grown. I mean, now you could maybe argue there's better case for it, but even now, market capitalization of crypto is not that large compared to all the stocks in the world and other investment vehicles. So it's still puzzling. But I think what you said is exactly right, that one can't, it's not that everybody was holding Bitcoin and just adding a little bit to the portfolio, but rather it was a very dedicated crowd that said, this sounds interesting, let me invest some money. And I know some folks who went all out investing in certain of these cryptocurrencies and lost their life savings, right? So for them, it certainly wasn't a small addition to their portfolio. And then naturally, if these are the investors, then the risk premium should be high. But that also suggests, if that analysis is correct, that as Bitcoin becomes more mainstream, now it's offered by financial advisory firms and so forth. They put it in the portfolio of their clients, as they put other stuff. They put gold, they put Bitcoin, they put I don't know what have you, right? I mean, all the possible investments in the world. There's a little add-on, right? And as we see this more and more, now it gets diluted relative to overall wealth, and that should mean that the risk premium should fall, right? Now that's a prediction for the future, and that's a dangerous one. So what that means that maybe Bitcoin is not rising in expectation as fast as it did.
Yeah.
So
it's the thing about this, just discussing the economics of Bitcoin, is that it offers grist for the mill for both the Kindleberger, Robert Shiller behavioral stories of finance, where there's herd behavior and there's fads driving prices, and that these can be socially important, right? They're not just we're not just explaining what people do in a casino over $20, right? We're talking about what people are doing with trillions of dollars.
Right.
But at the same time, it fits so many of the findings of normal rational expectations fueled finance. Right? Like you said, the halvings in Bitcoin do not lead to price shocks, right? The market has baked that in perfectly.
Exactly.
So it's it fits these nice clean tests. So I want to move on to talk about your paper on the lunatic stablecoin crash.
Right.
This was just to give the audience a little bit of information. It's just old news now by the standards of the world of crypto. And in May of 22, a creative stablecoin that many economists predicted would crashed.
Right.
But part of the puzzle is that this the coin actually managed to last for quite a while, and that its weakness was sort of visible and unfolding somewhat slowly.
Right, exactly.
This is often, again, grist for the mill for the behavioral finance crowd, for the irrational panic crowd. But you gave a very rational expectations explanation for this, for the Luna Terra disaster, as we call it.
Right. Yeah, no, thank you for mentioning that paper. And I have to desperately get back to revise the paper and send it back to a journal. I've been totally negligent on that. I plan to present it at a conference early August, so that gives me, and then this podcast gives me good motivation to get back into it. Now, but it's true, it's now old news, so who knows? Maybe the journal says, well, this was last century, right? What are you talking about? And it is true that many observers out there who looked at this, from a cursory perspective, said, "Oh, this can't be stable. This is an algorithmic stablecoin. This has to crash." But then, when you look closer, and that's what I tried to do in this paper, and when you take a rational expectations perspective on this, it's much harder to make that case. So let me explain, perhaps. So the Luna system had two coins really in play, right? So there was Luna and there was Terra. And Terra was the stable coin. There was Terra US dollar. and was meant to trade 1-for-1 against the US dollar. How did they do this? They allowed people to exchange the Terra coin into the amount of Luna of the corresponding dollar value. So Luna was a cryptocurrency like Bitcoin, warping up and down, sometimes high in value, sometimes low in value. So let's say you have 100 Terra US dollar, and Luna trades exactly at 100 US dollar. Then for 100 Terra US dollar, you would get exactly 1 Luna token. But now suppose Luna halves in price, then for 100 Terra, you would now get 2 Luna tokens and so forth. So the amount that you would get in terms of Luna was constantly adjusted based on the market price for Luna. And the Terra that were converted were destroyed. The Luna that were given were created. So there was this burning and creating mechanism in the background. So now in principle, so now let me take my simple Bitcoin paper analysis first, right, to see why this is now puzzling. So the Bitcoin paper says, the simple Bitcoin paper that I wrote with Linda Schilling says the Luna price should be martingale, right? So take out risk aversion for the moment. It should just bob up and down according to its own music. Sometimes goes up, sometimes goes down. The fact that there was conversion of Terra into Luna should play no role, similarly as the increase in Bitcoin played no role in our paper, right? It's paid for by the central bank, all right? But that's of no concern to the Terra Luna system. It just creates more Luna if people burn their Terra, or you take Luna out if people want more Terra US dollars. So it shouldn't have affected the price of Luna, and the system should have worked. That's, at first sight. Now, you could argue there were delays in the system. There are only certain people that could do it and so forth. So there are all kinds of institutional frictions in the system. But, from a close but not very close perspective, the system should have worked. I wasn't in the camp saying it has to crash because I have to find economic logic why it should crash. And the simple Bitcoin economics paper says it shouldn't crash, right? So then the paper, so how do I get that crash in the paper? In the paper, I say, well, there may be suspension of convertibility at some point, right? So people that invest in Terra might say, oh boy, maybe, as people are converting, right, eventually this system is going out of business and they're just going to stop the conversion. Okay, so then if that risk is baked in, then there's this fear, as it were, of the end of the system, and that creates a slow and unfolding crash. People attach this probability as they trade along, and so you can get this crash. Now, if you look at the data, the crash unfolded over 2 weeks. Now, 2 weeks in the crypto world is an eternity, right? It's a long time. And there were people buying Terra at that time. So it's not, a crash where you say, oh, this has a positive value, and out of a sudden the next second there's no value. Okay, that's an easy one, right? But why it was why Luna was gradually declining, and that's the hard part, because it doesn't seem to mesh well with this martingale explanation. And so that's the hard part in the paper, to get a gradual decline and it nonetheless being a martingale. How can it be a martingale? Well, because there's always a probability that it recovers, that this run comes to an end. People put a probability on this, and the probability dwindles over time, and therefore the observed Luna price along the path that we see keeps declining. And so it's consistent. So in the paper, the Luna price is a martingale, as in my paper with Linda Schilling. Yet, on the path that you see, it keeps declining. And so that's the juggling act that this paper performs.
So you use something called the method of quantitative interpretation for this.
Right.
Sort of applying a somewhat anthropological approach to
Right.
analyzing a real-time financial situation.
Right.
Tell us a little bit about that. And I suspect this is the kind of thing that this could be used well by other financial economists, I'm sure.
Right.
So
yeah.
feel
So
free to
exactly. Yeah. No. Thanks for asking about this. I try to solve that idea. So it's so I construct this model, and then the model is driven by the perspectives of people about what's going on, about probabilities. Let's say the probability of the system recovering. I think there were actually two parameters that people had in mind. But let me just talk about the probability of this recovering. All right. Now, you don't see that probability, right? And you can't, I can't ask investors directly. And it's not a constant probability. It must be changing because otherwise you don't get the decline in Luna price. But I can look at the price process and then back out what is the underlying probability that people must have had in mind that justifies the price process. So I call this the method of quantitative interpretation because it's interpreting the data through the lens of the model by coming up with a new time series that's a theoretical construct, that's an interpretation of what's going on in investors' minds rather than directly in the data itself.
So part of what's going on, part of what drives the crash in your story is the Luna, which is like the equity side of the bank, is following a martingale, just like Bitcoin does.
Exactly, right.
And so basically people are looking at the world and seeing, well, what's the probability of it having a couple more big downs that would make this thing infeasible? And the lower it goes, the more likely it is that you're going to get more big downs because it's lower, right?
Right.
The lower it is, the more likely you are to get to that threshold value.
Yeah, no, that's right. That's exactly right.
But at the same time, there's always a chance of resurrection.
That's right.
In corporate finance, people call that gambling for resurrection.
That's right. That's right.
And so every time it goes down, you're like, it's, and I don't know if in the model there is some magic number that's like the number where if it gets below that, it's done, or is it just sort of gradually increasing probability of decline?
I think I have to get back into the paper myself,
yeah.
But I think I set a threshold value. Is it that or some? I think I set some cap T. I think that's how I did it. So yeah. I have some terminal date, and it's sort of a run on the Terra coin. People keep exchanging it, but they could stop at any moment. So I said, okay, if they didn't stop at cap T, that's it. Then the system doesn't recover, and you could argue that the Luna system, the value for the Luna coin, derived in no small parts from being part of this Terra Luna, system. And the moment you give up on the Terra coin, the Luna coin has no value anymore. It's right. So the gambling for resurrection is that this run on Terra stops, and once it stops, okay, then the system is functioning again, and Luna has its value again because it's its counterpart to Terra, and that's a recovery that people were betting on in some sense. Why Luna was falling, but as it was falling more and more, the probability of that happening was also dwindling more and more, as you nicely described. Yeah.
So given that discussion of a de facto bank run, a kind of bank run, let's turn to a much more horrifying form of possible bank run based on another one of your papers. This is the JME on basically a bank run risk from central bank digital currencies.
Right.
Just for the audience. As of the present time, Europeans are much more interested than the U.S. government in pushing for something like a central bank digital currency, something that would work out something like individual deposit accounts run by the Fed or run by your central bank. There are a lot of different ways people could run a CBDC. And there are a lot of discussions about the sort of industrial organization effects of that on the banking industry or the monetary system.
Yes, right.
And really what you add in this paper published in the Journal of Monetary Economics, if I have it correct,
yes.
is that there's a systemic macro story here.
Right, yes.
And the idea that a central bank itself could be subject to a bank run through CBDCs. So tell us a little about that.
Yeah, so CBDC were developed, I think the idea came up after Facebook tried to have this Libra project. I think that got central banks really scared and suddenly thinking, well, this is scary, right? I mean, this is competition. We should do something on our own. And there were all kinds of white papers written and so forth. But you're right. In the United States, that train for now is pretty much stopped for all kinds of reasons, whereas Europeans go ahead. So the European Central Bank, they want to issue it. I think the last vote in the European Parliament has passed probably just last month. So this is a go as far as Europe is concerned. Now, CBDC is exactly what he described. It's everybody has a bank account at the central bank. And you might think, oh, that must be super safe, right? I mean, what's the problem in banking?
Exactly.
Banks do maturity transformation. You go to bank and you want to, withdraw from a deposit account, and the bank looks in its vaults and it has no dollars anymore, and it has to shrug its shoulders and say, sorry, we can't pay you, right? And if word spreads, then if a bank run at hand and so forth, right? So that's how bank runs, that's how we envision bank runs for an ordinary bank. For a central bank, this shouldn't be a problem, right? If you go to a central bank and you bring in your $20 bill and say, I want something else with it, they say, no problem. They give you two $10 bills, right?
Yep.
And if you want more of that, and if they don't have enough $10 bills in the basement, they just print them, right? So it looks like the central bank couldn't possibly run out of the things that they would give you in return, okay? And so what's the central bank run? Well, this was originally Linda's idea. Again, the paper is co-authored with Linda Schilling at Washington University, St. Louis, and then also with Jesus Fernandez Villaverde at University of Pennsylvania. So I think it was Linda who raised the idea, I want to think about a run on the central bank. And I told her, Linda, this is crazy, right? There can't be a run on the central bank. I remember saying that, right?
Yeah.
But she insisted, and the more we thought about it, we realized, no, there can be a run on the central bank. So what's a run on the central bank? Okay, so what's a run? Let's start there. What happens if you run on an ordinary bank, right? An ordinary bank, if you go and say, I want something for my deposit, the ordinary bank doesn't say, oh, okay, we give you other deposits, right? You would say, no, that's not what I meant, right? I want something else. I want dollars. I want the stuff that you don't have for the thing that you created. So with the central bank, one has to think about it in the same way. What do we want for dollars? We want goods. We want to go shopping. We want to buy things. And goods are things the central bank doesn't have. So run on a central bank is really a spending run, if you like, right? People start spending the money like crazy because they want to get rid of the money and they want to buy goods. So that's really run on a central bank. And we have seen them, hyperinflations. You can think of them as runs on central banks because people are just spending the money quickly in order to get goods. COVID, you saw these stock outs, right? Where people would go to shop and then load up their carts, with piles and piles of toilet paper, because they were fearing the goods won't be there, and next time around, right? That the shelves will be empty, and then you go in the shop and you have your dollars, and you want to spend them, and you can't spend them because there's no toilet paper. And in fact, these stock outs were very real, right? They happened.
Very real.
So whenever you see these spending runs, to me that's a way of thinking about the run on a central bank. Now, in this paper, we constructed it as a typical Diamond-Dybvig model. The Diamond-Dybvig model is the benchmark model for thinking about bank runs. And in the Diamond-Dybvig model, people, deposit resources. It has 3 periods. People deposit resources in the first period. They don't need it then, but they don't know whether they need it in period 1 or 2. So in terms of CBDC, they don't know whether they want to spend their CBDC in period 1 on goods or whether they want to spend in period 2 on goods, right? Do you want to buy your toilet paper in period 1 or you want to buy your toilet paper in period 2? Well, it depends on things I don't want to elaborate in detail here in this podcast, right? I mean, you can imagine what that depends on. But, there's individual variation. Okay, great. So what does the bank or, the central bank do with these resources? Well, they really have 2 options. They can just safeguard these resources, right? They can just, buy boring government bonds. Then they can always make payments, let's say. But banks do this maturity transformation. So they take these short-term claims, these liquid claims, these deposit claims, and invest them in firms, in projects that give off loans, in mortgages and so forth. It's an essential function of the banking system to do this maturity transformation, to take these liquid claims and invest them into longer-term stuff so that firms have resources to operate with, so that home buyers can buy a home and so forth. So if the central bank substitutes all from the banking system, if everybody takes their deposits, puts them at a central bank in form of a CBDC, so we envision an extreme world of that sort, no banks anymore, no deposits, it's only CBDC, people don't hold deposits at banks, they only hold CBDC accounts. Okay, so now the central bank is in a dilemma. They can also invest in these projects, as banks have done, then they're part of this maturity transformation, or they invest in something boring like government bonds, but that makes the economy very inefficient. Now, if they do the maturity transformation, then this tension that's there in Diamond Dipwick is back, right? It's not gone, it's just back. It just has a different color, right? And the spending one will then very much trigger exactly the same problem you have in a typical bank run. It's the same mechanism. Or they invest in borrowing, let's say, government bonds, but then the system is inefficient. And so we argue that that in this combination, the central bank wants to keep prices stable, right? That's a mandate for the central bank. They want to keep the economy efficient, and they want to avoid runs. And we say in this extreme world, you can only have 2 out of the 3. So it says CBDC. It's not true that an account at the central bank is safe, because it's safe in nominal terms, sure, right? But that doesn't mean it's safe in being able to buy toilet paper and buying real things with this. And that's the Achilles heel of any monetary system, and therefore the Achilles heel of CBDC.
Yeah, it's great to see another impossible trinity. Economists love those, and
Right.
I'm personally a fan. And to point out a new one is really good. I mean, the idea that we can always get repaid in nominal terms, but only if the central bank is willing to give up its ironclad commitment to price stability.
Right, exactly. Right.
And that's what we brought central banks around for in the first place.
Right,
or at least
exactly.
that's the leading reason for it, right?
Right, exactly.
Yeah.
Exactly. Yeah.
Well, we're drawing close to the end, but I want to bring us to another frontier question. You have a piece in a collected volume known as Frontiers of Digital Finance, and there you talk more generally about central bank digital currencies, some policy relevant issues, and you had some concerns about interest being paid on bank reserves.
Right.
Which is something that's a live issue in the U.S.
Right.
It's probably going to be debated loudly and openly, I assume, in the Warsh Federal Reserve regime.
Right.
So feel free to offer some of your views on interest on reserves, IOR.
Yeah. So I mean, it's an interesting evolution. The central bank wanted banks, after the great financial crisis of 2007, 2008, they wanted the banks to hold more reserves, right, to make them liquid, to avoid the problems of the Great Depression. And so they wanted to inject the reserves, but at the time, reserves weren't remunerated, and so banks were loath to hold them. And so they said, okay, fine, we want you to hold these reserves, but we pay you interest on it, right? And you can reason through that. It's probably a wash. It's fine. It did that. Okay. So now, but at the time, the central banks would say, once the crisis is over, the balance sheets will die down. Don't worry about it. But instead, the balance sheet has kept increasing. Occasionally, they have declined a little bit, but they kept increasing. And the central banks that do that have told us, there's nothing to see, and don't worry, right? It's efficient. It may be. I mean, it's actually a very tricky issue. I'm currently doing research with conclusions going opposite directions on some papers. But definitely there's interest on reserves, and it's huge, right? Because these reserves are huge, so it's a huge amount of payment. And you could say, okay, fine, that's what's needed to support the banking system. Certainly the advocates for that would argue as much. I know that Walsh thinks about it. He wants to shrink it, right? And so he's an opponent of this. So we'll see how this pans out. I mean, they just appointed a committee that should think about this. Kevin Walsh. So now the tricky part for me is, even if you advocate for large reserves and banks getting interest on reserves, you could argue, well, shouldn't that be available for everybody else too, right? So if and here stablecoins also come into play. So the US is going the direction of stablecoins. Europe is going the direction of central bank digital currency. So the central bank digital currency in Europe, they have decided, if you have an account at the central bank, you're not getting interest rate. If a bank has an account at the central bank, and as a bank, that's almost a definition of a bank. If you have an account at the central bank, you do get interest. But you as a private citizen have to pay taxpayer money to pay that interest, but you don't get interest, right? How is that fair, right? And I can imagine that eventually journalists is going to pick this up and make this a big deal, because it's unfair, right? Right? And now, same thing for stable coins, right? Why not offer stable coins, or the banks operating the stable coins, also master account at the Fed, where they can earn interest on their reserves? And then you would make that system much safer. You would make the stable coins much safer, aside from this CBDC bank run issue that we document in our payward returns. But that would stabilize this, there's no doubt. But again, there's, maybe they're going to have a limited account at the Fed that's not paying interest rates, right? I mean, why, right? So there is this. So the first question is: should stablecoins be allowed to have a master account, a version of a master account at the Fed? I would strongly argue we should. And Chris Waller, one governor that I deeply respect, is also pushed in that direction. So I hope this is going to come. But then also that it should pay interest. Now, Chris Waller has wisely stayed away from that, and I think he's stayed away from that because the only way to get this first idea through is by saying no interest. I mean, you can see the bank lobby pushing as hard as they can against.
They're very effective on
right
this. Yes.
Against stablecoins getting interest rates, against CBDC getting interest rates. For them, it's this is an easy money train, right? I mean, you deposit money at a bank, and you don't get anything on your deposit account. Then they turn around and put it on reserves. They get interest rate. They're earning money without having to do anything at that point. Now, in all fairness, banks do more. They do maturity transformation. They invest in other ways and so forth. So if you ran a bank just like that, that would be you couldn't make more money doing other things. But they already have an easy way to make money, and ordinary people are excluded from that. And I think that needs to be addressed eventually down the road. And I think it will be addressed down the road. So my perspective here is that once the European Central Bank digital currency is there, if it becomes a success, it could become the Susan B. Anthony coin, right, where it's just a toy for some nerds. But if it becomes a success and people use it and have sizable amounts on these accounts, then all these limits will fall. Then journalists will write papers, how come we don't get interest? How come that there's a holding limit and so forth? And so the banks have lobbied hard, yes, but it's, the wall will fall, right? And likewise for stablecoins, if stablecoins become big part of the US financial system, and now banks want to introduce their own stablecoins too, right? Eventually, I think the idea that they can't have a master account that pays interest, likewise, is going to fall. So I think that's where we're going. I'm excited about that future. As a monetary economist, suddenly, this whole system changes in ways that they haven't for many, many decades. And as a researcher, I find that exciting.
Yeah, it's a very, very exciting time to be a monetary economist once again, right?
Absolutely.
Yeah. On this question, I'll close then with this. I won't ask the Washington, D.C. question, which is what do you think will happen? But I'll ask the policy question. What do you think should happen from the point of view of systemic stability on the question of interest on reserves?
Yeah, so I think if you want to have large quantities of reserves, then you almost have to have interest on reserves, because otherwise, why would bank want to hold the reserves? How do you get banks to hold them? Yeah. So it goes hand in hand with the question, do you want large quantities of reserves? If you have small quantities of reserves, whether you pay them interest or not, doesn't really matter, right? I mean, it's just, banks would be annoyed for not getting interest on whatever small amount of reserves they hold, okay, but whether we annoy banks or not, I don't, it's not particularly relevant. But if you have large quantities of reserves, then you have to pay interest on reserves. I mean, it's, otherwise banks would hold them. So that's okay. Now, would you want to have large quantities of reserves? That's the $1 trillion question right now that Kevin Walsh is asking, and I think rightly so. There's surprisingly little good research in economics on that question right now that answers it. I'm currently writing three papers, I should say, but two papers in particular, and they reach opposite conclusions. So I'm going to put that on the table as a researcher. I can say, well, here's an argument this way, here's an argument that way. So let me give you both and see what you think. So the argument in favor of having large reserves is a Friedman rule type argument. The central bank can create reserves. I mean, it's a keystroke, right? It's a keystroke. It doesn't cost them anything to create reserves. In fact, it doesn't cost them anything to pay interest on reserves. It's another keystroke, right? And so the social. So then the private cost of holding reserves should be the same as the social cost of holding reserves, right? That's this Friedman idea that you should. He argued for a zero nominal interest rate, right? That was his idea, because he thought carrying money, is you don't get interest on money. So if the normal interest rate on assets is also zero, then there are no opportunity costs for holding money. So in Friedman's original analysis, he wanted zero nominal interest rate. Now, money in your pocket no longer plays much of a role, right? I mean, I still have some because I'm old and I'm conventional, but I know many people that don't carry any cash anymore. So it's reserves now, right? So the opportunity cost of reserves. What are the opportunity costs of not holding reserves? Well, I mean, you can invest in bonds, but you want to make that difference between what bonds pay and the interest on reserves as small as possible. Like Friedman wanted to make the interest rate on bonds and the return on money as small as possible. So it's the same argument. And so in order to do this, you want to have as many reserves as possible. You want to flood the market with reserves so that the market is flush on reserves. There is no scarcity premium on reserves anymore. And the Fed can do it, right? And why not get rid of a scarcity premium that's only created by the Fed? So that's the argument. You want to get, it's in the Fed's hand to create the scarcity premium or not. It doesn't cost them anything to remove the scarcity premium. Let them remove the scarcity premium. And that implies huge quantities of reserves and basically no spread between interest rates paid on bonds and paid on reserves. So that's one view, right? That's a view in which we have large quantities of reserves, ample reserves, abundant reserves, perhaps. All right. What's the counterpart to this? So that's one paper, and it pushes in that direction. The other paper, I'm saying, well, hold it here. The banks have to hold these reserves, and they have a balance sheet. They can't endlessly expand the balance sheet and hold more and more reserves, right? And so if that's the world where bank balance sheet can't easily be expanded, then holding reserves competes against other things that banks do. Yeah. So banks invest in projects, invest in mortgages, they invest in firms, they give out loans and so forth. If they only hold reserves, let's say, right, that would be the extreme, where they only hold reserves. Well, then they can't give out mortgages. Then they can't finance firms. And that would be a terrible world. Yeah. So that's a world where you have to strike a balance between the needed investments that banks ought to make, and the need for reserves as a payment instrument between banks. So it's a paper in which you have to look carefully at this balance. And what we find there, so that's I'm writing this with Frederick Bossai at the Bank for International Settlement. The paper is nearly done, so I hope that it comes out next month or so as a working paper, and then we have to try to get it published. So when you think about the options and so forth, we found a conclusion which, as a Chicago economist, I don't like it that much, but I mean, that's where the assumptions draw you to, which says that the reserves are useful, in particular if a market malfunctions. So the banks need to trade these assets on occasions, and they need reserves as a settlement instrument. And it may be the case that the market dysfunctions so much that this market freezes. In this model, it can come to market freeze. And in that situation, we argue that the central bank should step in and buy some of these assets to restore market functioning, even if the central bank makes a loss doing that. So in essence, ex post, they start injecting the reserves, not ex ante. You don't want to have a ton of reserves ex ante. It's much better to intervene ex post when the crisis is there and buy these assets and possibly eat some losses, but the losses are justified by the welfare gains of getting the system going again. Now, once you do that, though, then banks anticipate that they don't need reserves, because if a crisis comes, the central bank will step up to the plate and inject all the reserves that are needed, right? Mm-hmm. So why hold reserves ex ante? Well, that puts too much of an onus of the central bank ex post. Mm-hmm. So to avoid this, you want to have some liquidity regulation ex ante. You want to impose on banks that they ought to hold some reserves, but not as much as you would without this intervention ex post, so modest amount of reserves. So it's a combination of a modest liquidity requirement combined with this market maker of last resort stepping in if the market freeze idea. I'm not sure that I like government stepping into markets to help them. So you can see why I have some slight uneasy feelings about the result, but that's the result in the paper. And it says it's better to have modest amounts of reserves, not zero, but demand a very modest amount of reserves, and only inject reserves if you see these emergency situations. Now, if you look at the development of reserves in the United States, there are these episodes like COVID and some others
Yes,
where you see
definitely.
reserves spike up. So it's not the case. So one can argue that the high amount of reserves that got into the system because the central bank was doing precisely what we advocate for in this paper, namely becoming market maker of last resort. But and not as a, not so much as quantitative easing, that you just want banks to have lots of reserves ex ante. It really was, oh my God, there's a crisis, let's do something about kind of action. And we argue that that's the right thing to do. But that also means that in normal times you should shrink balance sheets again. So that's what that paper says. You should have a smaller balance sheet. Why? Because reserves compete against other investments. The Friedman rule requires, in some sense, for balance sheet to expand, and so that's really the tension. Can we expand balance sheets so that they can hold these ample reserves, or will they not expand balance sheets, and then you have this competing function? So these are the two ideas in play. On my side, I'm writing these papers, and one is going to be hopefully in circulation in August, the other one maybe in September, and then I'm going to have two papers with opposite conclusions. I have to, find out how to live with that, but that's okay. So.
Well, I look forward to people at central banks around the world debating those two papers and deciding which one they think is the one to follow. So
Right.
Great. Well, I don't want to keep you any longer. Thank you so much. This again has been Professor Harald Uhlig of the University of Chicago, who took time with us to talk about Bitcoin, about stablecoins, and about central bank digital currencies. Thank you so much.
Thank you so much, Garett. It was an honor to be part of this.